I'm joined by Marty Schmidt and Rick Ellsworth, our valuation experts, who are going to be helping us explore this nuanced and interesting topic. This particular episode is focused on the concept of intangibles as they might relate to the determination of tax basis that is driven by a fair market value as contained in an appraisal or evaluation document. So I want to not waste any time and kick it over to Marty and Rick to talk a little bit about intangibles as they apply not just to our industry that we're focused on here, renewables and energy transition, but I want to start by talking about how we've looked at intangibles and their determination in the context of other industries. Then, once we get a feel for how that has played out over a number of years, to apply that to our understanding of how it might be relevant in the context of renewable and energy transition assets. So, Marty and Rick, could you begin to take us down the path to understand this situation and orient ourselves appropriately?
Absolutely. Thank you, Dorian. Rick and I have been in the valuation business since the mid-'80s, both of us taking somewhat different paths, but ending up in the same place doing the same kind of work. And I really want to emphasize that the concept of valuing an intangible asset for tax purposes is 40 years old or more. We've been doing this for a very long time. I know it's just emerging really in the renewable energy space with some gusto, but it's been around for a very long time. So I'm going to take us back to the Tax Reform Act of 1986, which was the biggest change to the tax code since 1954. It's a major change. Many, many different things were changed in that act. But the one we're focused on now is something called the General Utilities Doctrine. General Utilities was a Supreme Court case in 1919, and then it was codified in the code of 1954. And under the General Utilities Doctrine, a corporation could sell an appreciated asset without paying tax on the increment, without paying tax on that step up. The details don't really matter, but in the Tax Reform Act of 1986, that free step up went away. At which point, allocating that step up between identifiable intangible assets and goodwill and going concern became important. That each of those had a different amortizable life for tax purposes. So we very quickly in the valuation profession developed techniques to value and determine the life of intangible assets. Everything from patents and trademarks to customer lists to every other intangible asset that you could think of. So we developed these methodologies, dealt with the IRS on that, and we had ways to value and determine the amortizable life of intangible assets. In particular, we did explicit valuations of going concern value and goodwill. We developed a very clear and consistent approach to how one looks at the value of goodwill and going concern value. And we'll get into that a little bit later. In the late 80s, there were numerous disputes between taxpayers and the IRS as they realized that our valuation approaches were valid and they were working. And it all culminated really in a well-known tax court case called Newark Morning Ledger, which was about primarily intangible assets. And in fact, Rick Ellsworth himself was the valuation expert for the taxpayer in the Newark Morning Ledger case. And so I'll let him give a little summary of that case.
As Marty indicated, back in the late 1980s, this concept of intangible assets and the amortization of intangible assets was very much a point of contention between taxpayers and the IRS. And that was because Marty mentioned this a minute ago, that if you had an intangible asset, you had to be able to estimate its value and also its remaining life with reasonable certainty. If you could do those two things, you were then entitled to take an amortization deduction for that asset. If you couldn't prove those 2 points of value and life, then it went to goodwill, which was not amortizable at that time for tax purposes. So there was very much an interest on the part of the taxpayer to identify intangible assets, value them, and estimate their life so that they could amortize the intangible assets. And whereas the IRS's position was that, no, these are all part of goodwill. They should not be amortized. And there were, as Marty mentioned, there were a number of disputes between taxpayers and the IRS in the late 80s and even going into the early 1990s. A lot of these were principally revolving around acquired subscriber assets. The Newark Morning Ledger case was, acquired newspaper subscribers. There were also other things such as bank core deposits that were subject to some of these controversies. And for the most part, the cases were being decided in favor of the taxpayer. The cases, the judges felt that, yes, the taxpayer had met their burden of proof in estimating the life of the asset and then also the value associated with it. So there were probably half a dozen cases in the late 80s, 90s that went favorably for the taxpayer.
And Rick, can you help me understand what it means to be in the taxpayer's favor in this context, right? So is it just that the position that they had taken was upheld, or is there maybe something you can tell us about the expected after-tax benefit that in those cases that the taxpayer enjoyed as a result of their position being upheld?
Well, as I mentioned a few minutes ago, Dorian, the decisions upheld the position of the taxpayer that the intangible asset was amortizable for tax purposes, so that they were entitled to make their amortization claim, and they were entitled to the amortization deduction for tax purposes.
And if they had that amortization deduction, those costs would have been locked up in some amount that would not be able to be deducted at any time for tax purposes.
It would then gone to goodwill, which was at that point in time not amortizable for tax purposes. And I mean, this was a very interesting situation. I mean, the Newark Morning Ledger case was really a landmark case because it was, I think, tried. The initial decision was in favor of the taxpayer. It was then appealed. The appeals court then decided in favor of the Internal Revenue Service. And then it was finally, in the early 1990s, then appealed to the United States Supreme Court, which then ultimately decided in favor of the taxpayer that, yes, the acquired newspaper subscribers were amortizable for tax purposes. And while this was going on, I think the IRS saw the writing on the wall, so to speak, and they started discussions around, creating some kind of recognition of amortization for tax purposes for most intangibles. And that's how we ended up getting Code Section 197, which allows for 15-year amortization for most intangible assets.
Right. So it was, there were a lot of disputes going on at that point. Rick was being a little bit modest. It was the Newark Morning Ledger case that just broke the back. The IRS threw in the towel, and it was rare. In my experience, it's rare that the IRS says we want Section 197 because these disputes with the appraisers are getting out of hand. They're killing us. They didn't quite say that. So truce, the entire increment of the entire purchase price premium, with a few small exceptions, is now amortizable 15 years, straight line. Thank you, valuation community. Please go away. And that's how we ended up with 197, simplifying the process quite a bit. But like I said, during that period, relatively short period, six years or so, we did an awful lot of work, but we had specific methodologies for valuing intangibles, including goodwill and going concern value. And Rick, I think it'd be a good idea to step back at this point and look at some of the methodologies that we had. I think the best known one would be a beneficial contract method. If you can give us a little background on that.
Okay. Yeah. As far as beneficial contract, understand when you're looking at an intangible asset such as a contract, you would value any contracts that have value to its owner relative to what the current market is. So that if you have a contract that enables you to buy supplies at a rate that's lower than the current market rate, then you would compare that delta, make a projection, however let's say the contract has an 8-year remaining life, project out the volume associated with the contract and then the favorable pricing, and calculate the delta in each year, and then present value that give an indication of the favorable nature of the contract. But in addition to that, you're also going to recognize the tax amortization benefit associated with that favorable contract as well. And that gets included as part of the cash flow analysis associated with valuing the contract as well.
One piece of context to make sure that we're emphasizing, this is all being done in the context of the acquisition of an ongoing trade or business. These contracts are not being valued in isolation. Everything we're talking about here, goodwill, valuing the contracts, is in the context of an acquisition of an ongoing trade or business, not just the acquisition of a contract. That's not a business, that would be an asset transaction. So it's very important that we recognize the context we're working in. And emphasizing Rick's last point, absolutely every time the value of the tax amortization of this asset was included in the value of the asset and amortized. So the concept that somehow that's a double dip is incorrect. That's the way it's always been done. Part of the value is the depreciation and the amortization. That's the value, and that gets amortized. There are a couple of different ways to execute that, but the concept is the same.
And now to jump the gun, but if we think about this preview as to where we're headed with this eventually, as it applies to renewable and energy transition assets, we're mainly focused on the availability of investment tax credits as they relate to the cost of an asset. So I might argue that the stakes end up being a little bit higher in the sense that when we're talking about intangibles versus goodwill, or intangibles versus ITC, in the former case, it's a question of whether we have a deduction, which after tax is valued at whatever your effective tax rate might be. Whereas in the latter case, we're talking about the difference between a deduction and a tax credit, with a tax credit being a dollar for dollar reduction of your overall tax liability, which in all cases is more valuable than a deduction. Now, I don't want to derail this very interesting journey through the history of how we get there. So please get back into it and transition a little later in the talk.
Absolutely, Jordan. Foreshadowing the sign of great literature.
Another valuation technique for valuing intangible assets is something that's referred to as the with and without method. And here you're going to prepare projections for the performance of the business under two scenarios. The one is with the subject intangible asset, and the other is a scenario without the intangible asset. And you're then going to just present value the cash flows under the two scenarios, and then take the delta there and then add the amortization tax benefits, just like explained in the beneficial contract method a minute ago. And this is a second method that's used for valuing certain intangible assets.
It's important to recognize you can only do that if the business is still viable under its same business model, with and without the intangible asset. How integral is that intangible asset to its business? I mean, conceivably, Coca-Cola could sell its product and go on the market and try to enter exactly the same formula without the Coca-Cola brand name. Substantially different value. Perhaps it could operate. I'd say that's actually changing the business model pretty substantially. Bringing it to a solar plant or just a solar facility with a PPA, with a power purchase agreement, and a solar facility operating merchant just selling into the market are two vastly different business models. So the concept, which we used to see, Rick, I really haven't seen it that much in the past several years, but for, in other contexts, maybe 10 years ago, the idea of here's the value of the solar plant with a PPA, here's the value of the solar plant without a PPA, the difference is the value of the PPA. That is just an absurd calculation, because certainly at that point, even now, the concept of a purely merchant solar plant is a very, very different business model than one that was built with the PPA, was financed with the PPA, and will operate with the PPA. So you have to be very careful with the with-without method, that by ripping this intangible asset out of the business, you haven't destroyed the business or so totally changed it that it's an inaccurate measure of the value of that intangible asset.
Yep. Thank you, Marty. A third method for valuing intangibles is something that's referred to as the relief from royalty method. And with this method, you're asking the question of what happens if you don't own the intangible asset? How much would you be willing to pay to license that from a third party. And, Marty mentioned Coca-Cola a few minutes ago. I mean, I think that's a good example of, okay, it's a brand that's known, worldwide, and the value of that name is just tremendous. And so if you were looking to value something like the Coca-Cola brand name, you'd make an estimate of what a third party would be willing to pay to license that name, and then once again perform your discounted cash flow analysis out for the really out into perpetuity, because the business is going to assume to go out in perpetuity, and then present value of that and the amortization tax benefit attributes to come to value for the name in that instance.
Maybe keying off of that, Rick, I think the idea is that when we purchase a business, we're purchasing the products, the markets, the brand name, operating expertise, and everything that goes in to the successful operation of the business. Now, that value that's inherent in the collective contribution of all those attributes, is that the same thing as a turnkey premium, if we've heard that word in the context of this industry?
I'll take that one. It's important that what you just described, Dorian, are attributes that were built up over many years before we bought the business. Markets, brands, supplies, techniques, all those things. That's the going concern value of the company, of the business, trade or business that we're acquiring. Because the concept that we used, again, when we were valuing going concern value, was that I'm buying this established business today. They've been in business for N years, and here's all the things that they did, and this is why I'm buying it, because it has brands and products and markets and supply contracts and all those things. If in the alternative, I, on that valuation date, said, I'm going into this business, I'm going to develop the products, I'm going to develop the brand names, the supply contracts, the markets. How long would it take me to do that? What would it cost me to do that? And what's the risk of failure of that? I've avoided all of that by buying the existing business. That's the going concern value. Going concern value of a business. Turnkey value only refers to assets. So when you look at a solar plant, that they, the suppliers delivered the panels, delivered the inverters, the guy with the truck brought in the gravel, all those things were there. If they were just sitting there in a pile, they wouldn't have as much value as they have on the valuation date, the placed in service date, where everything's been engineered, constructed, tested, and ready to go. So the assets have a turnkey premium because all of these things happen. You pay the EPC contractor, the developer did everything that he did to make this happen. That's the turnkey premium. And as I said, the going concern value is based on the status of the existing business. On the placed in service date, there is no existing business. It has the potential to be an existing business, and tomorrow it will be. We buy it the day before placed in service. For a solar plant, we flip the switch, we synchronize, and within a matter of hours, we have a full going concern for everything that it's ever going to be, because it's a 100 megawatt solar plant, and that's all it's ever going to be. But the day before the placed in service date, we had turnkey premium because we've done all this work over several years to have an operating machine ready to go. The next day, it's perhaps an operating business. It's, in any case, an operating machine at that point. So turnkey premium applies to the tangible assets. Going concern value only applies to an ongoing business. And in the case of a solar plant, as we talked about in the other example, it took years for the company to build up products, trade names, suppliers, and markets until it got to this point. The solar plant, in a matter of hours, goes from non-operational to fully, maybe even minutes, to fully operational. So any going concern value that exists the day after placed in service is de minimis compared to an operating manufacturing company.
I see. That's a very important distinction. And I think it leads us maybe gracefully into the next topic, which is 1060, as they call it. So code section 1060. Now, maybe just a little bit of background to set the stage for those who aren't familiar. Code section 1060 is where we learn about the process for applying a purchase price of a business to various classes of assets that are thought to be part of that business. So it gets things like cash on the balance sheet, receivables, property, plant, and equipment, or other items. So 1060 gives us what they call a waterfall to take our purchase price and run it through those various categories to see where we fall in terms of classes. Now, in the context of renewables and energy transition assets, I've seen diversity in practice in various situations as to whether a 1060 is going to be applied to the acquisition of something like a solar farm, to reuse the example that we've been revisiting. So, Marty and Rick, can you give me a sense as to how you think about 1060 and its applicability in the conduct of preparing a cost allocation for businesses generally, but then also in the context of renewables and energy transition assets?
The first point to make is that the valuation process and the allocation process under 1060 are two different exercises. That evaluation is always done holistically. Let's look at the whole business, like you said, and divide it up into these into the different assets of the business. I won't say asset classes yet, the different assets of the business. And we have a holistic view. We paid $1,000 for the business, and we've divided everything up from cash to excess being goodwill. And that's what we do. Then, only then, do we look at the purchase price and then start the mechanical process under 1060. We have the purchase price of $1,000. This one goes to class 1, 2, 3, 4, 5, and just keep allocating basis on the basis of equal to fair market value. When you run out of basis, you no longer allocate to the higher numbered classes. You do not look at the allocation under 1060 holistically. You did the valuation holistically. So that's what's very important. Whether or not 1060 applies is whether or not, for tax purposes under the tax definitions, a ongoing trade or business has been acquired. And for me, that's a very nuanced and pretty arcane distinction as to whether or not 1060 applies, and a bit out of my expertise. But in the end, it doesn't really matter for a solar plant, because if it's an asset acquisition, we've done the valuation holistically. Perhaps we've identified some intangible assets, and we've identified the bulk of the value has gone to the energy asset. And then as an asset acquisition, there could be some allocation that's done to the tangible and intangible assets. But we know for sure, if 1060 doesn't apply, there is no goodwill, there is no going concern. As I described earlier, both of those assets only exist in an ongoing trade or business.
When we look at 1060s, or the absence of 1060s, one of the questions that comes up in the renewable and energy transition space is whether the cash flow attributes of an operational project should fall into class 5 PP&E or into some other class that likely wouldn't be eligible to generate investment tax credits. So what I mean by that is, if you acquire a solar facility that you intend to operate, how do you think about the Alta Wind discussions that came to the conclusion that something like a grant in connection with the operation of a wind facility is a separate asset that you've acquired when you acquire something like a wind facility?
Well, I have three answers to that. Is a cash grant a separate intangible asset? Three answers are no, no, and no.
All right, let me write that down just to make sure I don't forget.
The cash flows to the energy property are the operating cash flows, the investment tax credit, the depreciation benefits, the renewable energy credits, as we've talked about previously. These are all cash flows that are generated by the energy property. Remember, if the energy property stops operating, all of those cash flows cease. In the case of the investment tax credit, it's clawed back. All of those cash flows absolutely, totally depend on the operation of the energy property. They are cash flow to the energy property. How they're generated, how the benefits are allocated, doesn't change it. Cash flows generated by the energy property.
Right. And when we look at something like the Alta Wind determination, where something like a grant was a separate asset, the implication would be whatever purchase price is applied to something that's deemed to be an intangible, to round out the discussion here, is something that would not be eligible for an investment tax credit. And that's been intangibles as not being investment tax credit eligible. I think it's been well understood for a number of years, and clarification was attempted in the proposed investment tax credit regulations that came out at the end of 2023, but that wasn't new information. I think that the discussion is, and always has been, around whether it's appropriate to allocate any of that purchase price to something that can be considered an intangible. Now, to loop back to the examples you and Rick went through previously, to allocate something to an intangible in those contexts with respect to the newspaper businesses was favorable in the sense that it provides deductions. But here, if something is allocated to an intangible, it's not favorable because while it may be a deduction, it's a longer lived deduction than you might have, first of all, as compared to applying that cost basis to, let's say, 5-year double declining balance property. And more importantly, to the extent something is classified as an intangible, it doesn't generate investment tax credits. So by bifurcating an asset into those constituent pieces and saying that some of those assets, those cash flows that might be generated, should be properly classified as an intangible, I think if I'm looking at my notes here, Marty, you said that the answer was no, that those items should not be classified as an intangible. And you really don't see a path toward those items being anything other in most circumstances than classified as energy property.
I agree with a small exception of should one of those cash flow streams represent a beneficial contract. Somehow it's different from a comparable market. There may be some small increment that's an intangible asset. Never seen that for investment tax credit. We do see it for power purchase agreements. So that's certainly a piece. That increment above market could be, but the investment tax credit is just like depreciation. And as Rick and I have been explaining, depreciation and amortization have been treated as part of the tax benefit from depreciation and amortization, have been treated as part of the cash flow for the valuation of assets forever. To suddenly say depreciation can be part of the cash flow, but investment tax credit can't, is just logically, it doesn't make sense.
Yep. And I think this has been great, guys. So thank you so much, guys, for walking us through the really rich and nuanced history around intangibles and their treatment for tax purposes, their establishment, and how those concepts may relate to renewable and energy transition assets. And I think the real big takeaway here is that when thinking about intangibles and their determination and their treatment, there's nothing new that we're dealing with from a conceptual perspective. It's just that now we're applying those tried and true established concepts to renewable energy and energy transition assets for the purposes of valuation and as an indirect consequence of investment tax credit determination. But the science here is well established, and we have professionals like Marty and Rick who have been down that road and back again and can help us navigate these issues and come to the correct conclusion. And again, thank you for joining us. And I hope you join us again for our next episode.